Welcome to Yahoo Finance Live. I'm Shauna Smith along with Diane King Hall. Let's get you up to speed on the market action. The final trading day of May, and you're looking at losses across the board. The Dow off just about 123 points, S&P off about 0.5%. The Nasdaq, which has been by far the outperformer for the month of May, on track to close up the month just over 6%. That's actually in the red this afternoon, off just about 0.4%. Well, we are an hour away from wrapping up the month of May trading here. Jared Blickery is on the floor of the New York Stock Exchange with a closer look at some of the biggest movers that we've seen over the last several weeks. Jared.
Yes, well, Shauna, you nailed it. It's really been all about the tech trade in May. Let's go straight to the Wi-Fi Interactive so we can plot exactly the disparity that has evolved here. So here's the Dow. You can see just about everything in the red today, but here's the Dow over the last 22 days, which is the number of trading days in May, down 3.5%. You take a look, and by the way, the S&P 500 barely positive here. I'm going to skip right to the Nasdaq. Nasdaq is up almost 6%. And you'll probably see some statistics after the close. Well, we haven't seen the Nasdaq outperform the Dow by this much in 20 years and 40 years. I would expect a lot of that. It's been a while. Suffice to say that this doesn't happen usually. This is not the norm, and we're in a very, let's call it a special situation. Now, I want to go to our sectors and see what they've done for the month. Not surprisingly, tech in the forefront. It is up 9%. That's followed by communication services and discretionary. All three of those are the mega cap sectors, so not a big surprise there. But energy down 10%, materials down almost 7%. Just about everything that wasn't a growth or mega cap, that has been down. And we've seen it really in the forefront if you take a look at what's happened with the semiconductors. And looks like the Wi-Fi Interactive is slowing down a little bit. But if we take a look at that, we're going to see the outsized gains not only of Nvidia, but let's not forget other stocks like Marvell and AMD catching up as well. All of this, just kind of a recap on the month. I'd be remiss if we didn't look forward to June. June has not the best seasonality. It's one of the weaker months of the year. And of course, we're still in the middle of summer. We're not expecting any big liquidity days. If, for instance, you had a huge position on and you wanted to flip it or you wanted to do something else, you're going to have to wait until there's liquidity in the market. That's going to come on the Russell rebalance date. But that's only in a few weeks. Other than that, we don't have a lot of big liquidity drivers here. And plus, we got that big Fed meeting. We'll probably see some liquidity around that Fed decision in a couple weeks. So just to round this discussion out, I do have on the Wi-Fi Interactive, finally, our plot of S&P 500 index seasonality for the month of June. And you can see it's down there, and that's after a May that is usually flat. And as I like to say, it's not sell in May and go away. It's hedge in May and go away. That's what a lot of the big players want to do. They don't want to come back here. They want to stay at the beach, guys.
They do want to stay at the beach. I'm one of them, but we will see what the month of June brings. All right, Jared Blickery, thanks so much.
Oh my goodness, that's a new one. Hedge in May and go away. I have not heard that one. We know the sell in May and go away. All right, so job openings in April rose to their highest level since January, which comes ahead of the monthly jobs report. That's due on Friday. For more, we welcome Christina Hooper, Invesco Chief Global Market Strategist. So we had that JOLTS data come in hot today. Frame that for us in the context of this market. We're wrapping up a month, heading into a new month. How do you take this all in?
Well, what the Fed wants to see is a cooling of the economy, right? Because that's what leads to a cooling of inflation. So I think that's why we're seeing markets react negatively, is that we got this positive JOLTS report. Now, having said that, though, we have to look at the survey itself. A very low response rate. And that often means that what you see is it's skewed to the upside, because who's going to respond? The ones with more positive news. So it could very well be much ado about nothing, but it does suggest that the labor market is tighter. I mean, we're back above 10 million job openings, and that's a very high level, especially if we can compare to pre-pandemic levels of 7 million or less.
So, Christina, what do you think this means for the Fed, just in terms of how the Fed is looking at this? They certainly have left a June rate hike on the table. Do you think that's likely? And do you think we could actually be looking at another one come July?
Well, I actually still am of the belief that the May meeting, they decided to enact a de facto conditional pause. I don't know if many agree with me, probably not.
So.
Yeah, well, some.
We'll see.
I think the idea, and if we looked at the language and compared it to the 2006 language when they decided to end rate hikes, very similar. And not that dissimilar from Bank of Canada's language back in January when they hit the pause button. So I think what we're going to see most likely is a pause in June, giving time to assess the data. That's certainly what we heard from Jefferson, from Harker, and keep that sort of Damocles hanging over markets, right? So that financial conditions don't ease by saying, hey, we might still hike rates in July or beyond, but I don't think we're going to see any more hiking.
And given the kind of perspective you gave us, what do you see as the sector leaders for the summer?
Well, I think a lot of that is going to have to do with markets forecasting what is to come.
Right.
So right now there's a lot of uncertainty, and when we have policy uncertainty, we tend to have a risk-off environment, and I think that's going to continue. So we're likely to see a secular growth like technology. We're likely to see more defensive areas of the stock market like utilities, like healthcare perform better. Larger caps perform better. But then once we get clarity on policy, once everyone's certain that the Fed has stopped hiking, and once we get a debt ceiling resolution, and that means signed, sealed, and delivered, then I think markets will start to, at a certain point, discount an economic recovery next year. And I think they'll start to discount that in the back half of 2023.
But isn't the debt ceiling kind of considered a rearview mirror now for markets?
Well, it certainly is. We're in a better place than we were last week.
Right.
But I don't think it's over until it's signed, sealed, and delivered.
Yeah, that's very important to point out. If we get too far ahead, clearly we could have pretty terrible ramifications over the next several days. Christine, let's talk about what we have seen just in terms of leadership since the start of the year. We're rounding out the month of May. We're looking at the best month for the Nasdaq 100 that we have seen, month of May for the Nasdaq 100 that we have seen in just about 18 years. Certainly this leadership mainly driven by many of those larger cap tech names. Are you worried at all just about the narrow breadth that we've seen in the market?
Now, Shauna, I think you make a good point. That's a really important question to ask. I do think there's always some concern when you see real narrowness in the market. But if we take a step back and look at it in the context of where we are in terms of the market cycle, this is a time in which the economy is slowing down, markets are positioned more defensively, and we typically do see a narrowing of markets. But we can look ahead to that market discounting and economic recovery. That's usually when we're likely to see a broadening of the stock market. So I think it's not that unusual for where we are right now, although it's never a great story.
Right. And quick, just to extend on what Shauna was talking about a little bit, the AI craze has really fueled big gains, particularly within the tech sector and these mega cap stocks. I mean, you had what happened with Nvidia this week, hitting that kind of $1 trillion level that is a rarity. The air is thin up there. What does that signal to you? Are we in the early stages of those kinds of gains that we're seeing? Is this reminiscent of the dot-com bubble to you?
Diane, I'm old enough to tell you I lived through the dot-com bubble. I don't believe it. Maybe in middle school. But you know, seriously, this is somewhat reminiscent because the underlying, the excitement is for a good reason. There's some real underlying growth potential there, productivity gains, all those things. But it can get effervescent and frothy. And that's what we're seeing right now. I mean, I remember when companies were changing their name to .com and had nothing to do with the internet at the time. So certainly, you know, there's been this decision made on the part of many investors that, oh, this is an AI-related company, whether or not it really is an AI-related play, and there's just a lot of excitement there. I just think it's more of a secular phenomenon. We go through these stages, and we're living through one now. I think the bigger, but I think that is a countervailing force right now to what had been rising yields in May. You know, typically we see tech go down when yields rise, but I think there's just an awful lot of confusion around the Fed and what the Fed is going to do. You know, a disinflationary process is never perfect, and so we're going to get some ugly data points that make us question whether or not the Fed is going to see us get to the inflation target that it is set. But I do think we're getting there.
Christine, let's talk about what we're seeing on a global scale, because we just got the recent data out from China. Obviously, the recovery there taking much longer than maybe many investors had initially anticipated. The factory activity falling there to about a 5-month low. How do you see, what are, I guess, the global implications, economic implications. Why should U.S. investors really take note about what's happening over in China?
So, because China is such an important part of the global economy, whether or not you want to be directly invested in China, you need to pay attention to it. And in fact, there are a lot of plays on China growth that aren't necessarily China stocks. But to focus on your first question, really what's going on in China, what we're really seeing is a tale of two economies, which is not dissimilar to a lot of other developed economies. Yeah. When they reopened, what we saw was services do well and manufacturing not do well. And of course, China is the world's factory, so it is being impacted by the economic slowdown that has been manufactured by central banks all around the world. So I focus in on China services, and that is still in expansion territory. It's the slowest expansion in the last 4 months that we've seen, but it's still in expansion territory. I'd like to think that the Chinese economy right now is taking a breather. But this reopening has real legs. You don't close down an economy for more than 3 years and then reopen it and see it sputter out after a couple of months. I think this is a very, very long coiled spring. And I think we'll see this play out over many, many, many months.
Is inflation still cause for concern for the markets going into this next June? I cannot believe we're about to be in June.
Inflation data is still a cause for concern just in terms of expectations about how the Fed will react to it. But I firmly believe that inflation really should be a rearview mirror issue.
Okay.
The Fed has done enough. We just haven't seen a lot of the impact of tightening. Usually there's a 12 to 18 month policy lag. So we haven't seen a lot of the damage that the Fed has done to the economy and inflation, but we will. And so I think the better course of action for the Fed is to sit on its hands and wait for it to show up in the data.
Okay, we'll see if they listen. I don't know if they are. We shall see.
Fingers crossed.
Yeah, indeed. And there are some different viewpoints there, so we'll see. Our thanks to you, Christina Hooper, Invesco Chief Global Market Strategist. We are just getting started here on Yahoo Finance Live. Coming up, the House will vote tonight on the debt ceiling deal, and we're taking a closer look at the economic impact of the bill, especially as the pause on student loan payments comes to an end. Plus, Bitcoin is headed for its first monthly loss of 2023. We dive into the crypto sector later. And Nvidia grabbing headlines over its brief $1 trillion valuation. What other companies should investors be keeping an eye on? We dive into that all later this hour.
Jobs Day in America is this Friday, and here's a taste, no pun intended, of what's coming to Yahoo Finance. We'll be in Times Square speaking with the CEO of Krispy Kreme. Yes, I will be eating all the donuts. We'll head down to DC for live reaction from the White House lawn. We'll be in Arkansas speaking with Walmart workers, LA, where Hollywood writers are still striking. We've got you covered coast to coast to tell your story. So make sure to tune in on Friday for all-day coverage right here on Yahoo Finance.
If lawmakers vote to pass a debt limit bill, millions of Americans could be in for a bit of a shock. The legislation will officially end the freeze on student loan repayments, meaning that payments are set to resume by the end of the summer. Here to break it all down, the economic implications of this, we want to bring in Thomas Simons, Jefferies U.S. economist. Thomas, it's good to see you here. I know that you've been digging into exactly what this will mean for Americans. When it comes to the economy, what could this potentially do to consumer spending?
Yeah, I think that it's a really interesting topic because it's something that's very, very difficult to quantify. You know, when we stopped the student loan payments back in 2020, it came alongside all these other stimulus packages that we're going through at the same time, right? Direct stimulus checks, bigger unemployment benefits, rent moratorium, all sorts of different things. So it was really hard to isolate exactly how much of a stimulus we got just from stopping those payments, which we have seen a number of different sort of estimates on you know, how much student loan borrowers pay per month, but it looks like it's somewhere around $400 a month on average. So now that we've seen all these other stimulus programs and packages expire and sort of, you know, rebound back to, you know, we've gotten the payback on that. We haven't seen it yet with student loans. Like you said, we're very likely to see that as soon as, you know, we get into August and September at this point. And, you know, it looks very similar to what we saw in 2013 with the fiscal cliff. Back then, there were some temporary tax breaks that were all kind of expiring at the same time. And if they all expired at the same time without any sort of offsets, it would have been a very significant fiscal drag. The deal that came together essentially amounted to a 1% increase in payroll taxes for, you know, people who receive a paycheck from their employer. That ended up generating a drag of about 1%, a little bit more on discretionary spending. To overall PCE. So, you know, when you look at economic growth in the first half of 2013, there's a very noticeable dip in PCE and thus dip in GDP as well.
And speaking of that, Thomas, Diane here, what are you expecting as for the broader impact to the economy from? So obviously this could clearly have an impact on consumer spending, but what's the overarching ripple effect that you expect to see from these student loan payments coming back into people's household budgets?
Yeah, I mean, there's you know, obviously the direct sort of headline impact in terms of having less to spend elsewhere. But the other issue is, you know, not just spending on goods and services, but also servicing debt as well, too, right? Mm-hmm. We saw delinquency rates on credit card loans and mortgages, auto loans, you know, any sort of consumer loan fall to very, very low levels during the, you know, the immediate sort of aftermath of the pandemic. And that's as student loan delinquencies essentially fell to zero. You know, it's hard to be delinquent on a payment that isn't necessarily required of you at that point, right? So as we're now adding this back in to balance sheets that are already pretty strained by 2 years of very high inflation that's run significantly higher than wage growth, the capacity to absorb this in a lot of budgets, I think, is much worse now than even, you know, again, we're talking about our 2013 example. You know, economic growth was relatively slow back then, but interest rates were really low. Inflation was really low. The labor market was still in the process of recovering. There were a number of sort of offsets, I think, that you could say, all right, well, you know, the households will be able to absorb this eventually, and that, you know, we won't see growth, you know, impaired for a long, long time. But here I'm much more concerned that because, you know, consumers have taken down essentially all of their excess savings from you know, period of time during the pandemic when they couldn't be spending money, you know, during the lockdowns and that sort of thing. As they've, again, had to use those savings to offset the impact of inflation, I think now it's just the worst possible time for many of those households to be hit with this extra bill.
Yeah, it certainly is a very terrible time. Millions of Americans can't afford it right now. Thomas, what does this mean just in terms of the odds of a recession? We know the consumer has been one of the bright spots of the economy, has been extremely resilient, like you have been saying, really throughout the pandemic. Does this then increase the odds that we'll see a recession?
I think it does. You know, I've been expecting that we're going to get a recession towards the second half of this year for a long time now. And the student loan issue just kind of compounds issues that I think are already sort of set in place in not only in the consumer spending mix, but also in the labor market, which is eventually, of course, going to lead to further issues with consumer spending down the road. I think that businesses have done really well in passing along increased costs to consumers so far. It has really, been remarkable. I had expected there would be much more margin compression this year, and instead they've actually done a pretty good job of recapturing a lot of that margin. I don't think that happens on an ongoing basis, into infinity. Because again, I think that a lot of those cost increases have been absorbed by this savings that has a finite amount. There just really isn't that much more to go. So if we do see the next phase of margin recapture and growth for top line, or actually I guess bottom line for corporations, I think layoffs are really the next piece of the puzzle, because it's basically the only way that they're going to be able to find cost savings significant enough to continue to deliver for investors. But as that happens and we see wage growth slow, it's going to really impact consumer spending as well. Sorry.
So, Thomas, I got to ask, though, the job market has shown itself to be surprisingly resilient. We had the last jobs report was better than expected. Once again, we have another one coming this Friday. We had JOLTS out today that was, was that more than 10 million. That was more than expected. So are we really expecting the jobs report showing anything but more gains? Like, when are you expecting those layoffs to show up in the monthly numbers?
Yeah, so I can't sit here and tell you that I think we're going to get a poor number on Friday. I actually think we're going to get something, around 230K for payrolls and basically an unchanged unemployment rate. But these are all more or less, I think, lagged indicators telling us sort of where the labor market already was for the last few months. The primary job growth engine so far during this expansion has been in small businesses. And you referenced the JOLTS data. We saw this huge increase in businesses with only 1 to 9 employees, producing many of the job openings and thus many of the jobs. Now, those are brand new businesses that have just been started. We've seen an explosion of those businesses being started throughout the last 3 years. I really suspect that given that their primary source of credit is through bank lending, that there's not going to be this further and further legs of that same sort of development of small businesses. I don't think that this is something where you can say, oh, well, we had all these issues in the regional bank system that have now kind of impaired this flow of credit and we're going to get all these negative consequences. These were already sort of things that were set in motion by all of the cumulative rate increases that we've had so far through this cycle as well. Credit tightening has happened on the lending side, and also demand has fallen off sharply as well. And I think that as we see that demand translate to fewer small business creations, it's going to lead to less hiring, and thus as we see less sort of gross hiring in the labor market, we'll start to see weaker businesses fall off and have to cut headcount, unfortunately.
All right, Thomas Simon, something we, of course, will continue to closely watch. Thanks so much for joining us here. Jefferies U.S. economist.
Meanwhile, investors believe Apple will unveil its new mixed reality headset next week at the Worldwide Developers Conference in Cupertino. But will this new product have a greater impact than its competitors like Meta's Quest? Here with that story is Yahoo Finance's Dan Howley. Dan, what can we expect?
That's right, Dan. We're expecting a headset from Apple. It would be the first major product launch since perhaps the Apple Watch. Well, you can throw in there, I guess, the AirPods, but this is going to be a completely new platform, new software. According to reports, it will have a very, very high-end display, something that we haven't seen from other competitors, micro LEDs. That's really like the top of the line you can get as far as display technology. Super brightness, so that should be quite impressive. We have Dan Ives, Wedbush analyst, basically pointing out that there will be numerous apps for it. It should launch at a price range of $3,000, so yikes on that. I'm not going to be picking one up. And the processing power should come from an M2 chip. Now, I think what Apple's going to have to lay out is why you want a AR VR headset. Apple's been able to come into other categories before that have already been defined and essentially redefine them and take over them. It did it with the smartwatch. It did it with true wireless earbuds. It did it with the tablet. It did it with the smartphone. Can it do it again with a mixed reality headset? And that's the big question I think a lot of people have. Most consumers don't have mixed reality headsets or virtual reality headsets at this point. Those that do, there have been conflicting reports on whether or not they actually stick around to use them, or if they just collect dust in their closet after going through, the first kind of honeymoon period with them, and then they just kind of say, well, I got my big TV, why do I need this? So that's going to be something that Apple's going to have to overcome. But if it's any company that can do it, I mean, you got to imagine they can.
Yeah, I was going to say, if anyone can do it out there, if anyone can get this to go mainstream, it will be Apple. So we'll see whether or not we do get that next week. And then, of course, what the consumer reaction is to that. But Dan, when it comes to the talk of tech this week, it's been all about Nvidia joining the $1 trillion club. But Apple has also hit another $1 trillion milestone for itself. Tell us more there.
And that's right. There's a report from the analysis group that says Apple has facilitated or experienced in commerce from its App Store $1.1 trillion in 2022 alone. And that's, I believe, a 29% jump from last year. This is essentially something that's unheard of. Now, Apple putting this out, analysis group putting this out, Apple funded the study. So just to caveat that. But part of the discussion that is had in this report is that 90% of that money didn't go to Apple. It was through sales outside of apps, or rather in apps outside of the App Store, websites, things along those lines. So not necessarily going to Apple's coffers. And I think, this comes at a time when Apple's facing that scrutiny from regulators over its App Store practices, not to mention Google, which has similar practices. The Digital Markets Act in the EU is going to force Apple to open up its platform to third-party app stores, as well as third-party payment options. So we could see changes coming as far as the amount that is facilitated or the amount of commerce that runs through the App Store. But we'll just have to wait and see when we start to get those new rollouts of those app stores. But truly a tremendous number here, $1.1 trillion.
It's pretty crazy. $1.1 trillion in just a year. Dan Halley, great stuff. Thanks. Well, coming up, could a Fed pause be coming in June? One Fed governor thinks so. We'll break it all down for you when we come back.
The Fed has revealed some of its thinking today ahead of the next rate decision, suggesting a pause could come in June. That's according to Governor Jefferson, who spoke ahead of the release of the Beige Book, and Philly's Governor Harker soon followed suit. Yahoo Finance's Jennifer Schonberger has been following this. Jen, take us through what you've got.
Hey there, Diane. That's right. Two Fed officials suggesting that the Fed could pause rate hikes at the June meeting, though that wouldn't necessarily mean that the Fed is done raising rates. Fed Governor Philip Jefferson, speaking this afternoon in Washington, said, quote, "A decision to hold our policy rate constant at a coming meeting should not be interpreted to mean that we have reached the peak rate for this cycle. Indeed, skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming." Meanwhile, Philadelphia Fed President Patrick Harker, speaking at a Q&A in Philly this afternoon, said, quote, "I am in a camp increasingly coming into this meeting of thinking that we should really skip, not pause," though Harker reserved the right to look at the jobs report on Friday and the consumer price index due out on the first day of the Fed's meeting, June 13th. Harker said he likes the word skip as opposed to pause because pause implies that the Fed would be stopping raising rates for some time. Though he noted that the Fed might have more work to do and he's willing to do that, but he just wants to give it more time. Now, these comments are coming after jobs openings spiked to the highest level since January, and after a report on Friday that showed inflation accelerated in the month of April. Take a look at the Fed funds futures, because this morning they were pricing in a better than 70% chance that the Fed would hike rates at the next meeting. Now, after Jefferson and Harker's comments, a 64% chance of a pause next meeting. Elsewhere, meanwhile, the Fed's Beige Book showed inflation is slowing down, and several districts noted that consumers are showing more sensitivity to price increases. High inflation also and the end of COVID benefits have continued to put stress on budgets for low to moderate income households, and they are seeing more demand for social services, including food and housing. Ladies?
Jennifer Schonberger, thank you so much.
The comments from Philip Jefferson and Patrick Harker sparking a major swing in the Fed fund futures. Earlier today, the likelihood of a rate hike in June sat at more than 70%, and now we're at less than 30%. Our next guest, though, has been expecting rates to rise at both the June and July Fed meetings and still has that as her base case. Let's bring her in. We want to talk to Veronica Clark, a Citi economist. Veronica, it's great to see you here. So you still think 2 rate hikes are warranted. Why?
Yeah, I do. I would be cautious with some of the Fed comments that we got today. I think this is a really genuinely data dependent Fed at this point. We do, of course, still have jobs report on Friday, CPI right ahead of the June decision. If we believe that the Fed is truly data dependent, then our Fed funds forecast comes down to what we think is we're going to see in the data. It comes down to our inflation forecast, our jobs forecast, and we still see a lot more persistence to inflation than I think the Fed does, and that means rates still need to rise more.
So you said the Fed is data dependent, but you have a couple voices coming out today and kind of signaling the expectations for pause. That really doesn't change your base case at all or give you pause to that thinking.
Yeah, they were definitely dovish comments, I think, relative to what we were pricing this morning. I think this is a Fed that, if they're data dependent, then the chance of a hike at any given meeting should be dependent on the data. And we were pricing, close to 20 basis points for the June meeting this morning after we had those strong job openings numbers. If you want that to be more like 50-50, I think maybe that's what Fed officials were trying to do now, really let it be swayed by the data that we're going to get on Friday and on June 13th.
Veronica, what about the risk of recession? Many people are warning that, hey, we might want to pause, see how things play out. And not just some Fed officials, we also heard it from a number of economists. What does this do, though, if we do see 2 rate hikes in the month of June and the month of July? What does that do in terms of the odds of a recession and what that could potentially look like?
Yeah, we do have a mild recession in our base case really for the end of this year. Although I think everyone has been pushing out their expectations for when a recession might come. We have just seen a lot of resilience in the labor market, in activity and in consumption. But we are expecting that to happen later this year. But it comes down to, we're trusting that the Fed is going to do what it takes to get inflation lower. And from our standpoint, rates aren't quite restrictive enough, and getting them restrictive enough, does cause a weakening in the labor market, does cause a recession, but it importantly is enough to bring inflation back to 2%.
Yeah, Veronica, you mentioned a few times that inflation remains, you expect it to be pretty sticky here, persistent. I guess how sticky do you expect some of these higher prices to be? When we look out to the end of the year, what do you think that inflation number most likely will be right around?
Yeah, I think a lot of the inflation data gets a little bit tricky, a little bit more nuanced here. We've seen the slowing in goods prices. That's related to supply chains correcting. Shelter prices are starting to come down now. But the really sticky part of inflation, which is only about a third or so of core CPI inflation, but over half of the Fed's measure PCE inflation, which is those non-shelter services. Those can stay really strong. Our forecast for core PCE inflation, which the Fed is going to have to update their own forecast in a couple weeks, is for 4.2% still for the end of this year. The Fed's forecast is very likely going to come up in June. They're last at 3.6%. We're still much higher than that.
Veronica, so the consumer has consistently been the backbone of the economy. Consumer spending has held up. But one of the things that we've been looking at is the potential impact to consumer spending resulting from this debt ceiling deal that's going to be voted on later today. And one of the points in there is the pause on student loan payments will go away, basically. What do you expect to be the ripple effect, the economic ripple effect to consumer spending resulting from people having to pay their student loans again?
Yeah, it should probably weigh on consumption, maybe just by a couple tenths from some rough numbers. I think most importantly, though, for consumption, we have had some excess savings that are still going out. But most importantly is that the labor market is still really strong. People are, still employed, still earning a higher nominal wage than they, were a couple years ago. That's really what is still supporting consumption here. And until that labor market story changes, I wouldn't expect actually a real big drag, on consumption.
What are you expecting from the jobs report this Friday?
We have a 200K payroll forecast. The unemployment rate staying low at 3.4%. Wages, average hourly earnings rising about 0.3, but with some upside risk there.
Veronica, I know we're jumping all over here, but bringing it back to how the Fed is looking at this data that we're getting out, the home price number that we got out earlier this week, rising for 2 months in a row. How problematic do you think that is for the Fed?
Yeah, we had some interesting comments this morning from Fed Governor Bowman about, housing, which, is a new upside risk maybe to inflation. Home prices specifically are not, an input into consumer inflation measures. It's shelter prices that are measured by rents. But if housing demand is bottoming, which it seems like it is, and housing supply could still be pretty limited, people are hesitant to sell homes and relinquish lower mortgage rates, there could be upward pressure on prices still, and there's some limit then into how much shelter prices might ease. They probably still do for another 6 months or so, but there could be some floor there, and it is probably a new upside risk that the Fed should be a bit worried about.
And speaking of what the Fed should be worried about, what would change your view about what the Fed would do? Like, would it be the jobs picture happening this Friday change what you're thinking? I mean, you said that this is obviously a data-dependent Fed. What changes your expectations for the Fed's meeting in June and July?
Yeah, it absolutely will come down to the data for us also. There's certainly a weak enough number that we could see on Friday that might do it. Maybe something less than 100,000. I think the market is maybe expecting that we need an upside surprise to payrolls, an upside surprise to CPI that we'll get on June 13th. I would think that maybe the bar is a bit lower for how strong the data might be for the Fed to still be hiking, because they're going to have to update their forecast in June, and they'll have to update them in a way that shows stronger activity, stronger inflation, and that should mean higher rates still too.
Great insight. Veronica Clark, City Economist, our thanks to you. Coming up, a closer look at the AI boom for stocks. We're talking to a portfolio manager on the other side about a few tickers to keep an eye on. Stay with us. Tech giant Meta held its 2023 annual shareholder meeting covering several topics top of mind for investors, including censorship policy and the future of the metaverse. Here with more on the biggest takeaways is Yahoo Finance's Ali Garfinkel. Ali?
Hi, Diane. So if there's one thing to know here, it's that just because Meta stock has exploded this year, it doesn't mean shareholders don't have questions. In fact, shareholders seem to have a lot of questions, both about where the company has been and where it's going. Now, a lot happens at these shareholder meetings, but if I had to distill it down, I'd sort of put it into 3 points. Number one, Meta is staying lean. As has been talked about a lot, Meta is in its year of efficiency, and moving forward, there will probably be fewer layoffs. At least that's what Mark Zuckerberg seemed to suggest. I'll believe it when I see it, but moving ahead, there will certainly be less hiring at Meta. And one of the things Zuckerberg also called out was this idea that developing AI-efficient tools will also enhance productivity at Meta. So that was sort of point number one, year of efficiency continues, perhaps less layoffs. Now, moving right ahead, continued investment in the metaverse. In my notes, I wrote down, we're investing in the metaverse, gosh darn it. There's something that I've heard over and over again from Meta executives and now from Zuckerberg at the shareholder meeting, which is something to the effect of, we're hearing this narrative that we're not investing in the metaverse anymore, and that's simply not true. That said, Meta is being very clear about the fact that the metaverse investments are going to be long-term, incredibly long-term is sort of the way they've kind of been suggesting at it. They've also been very clear about the ways in which AI is very inextricably linked in their metaverse plans. Now, I think they're being a little slippery on the AI metaverse connection still. AI is in absolutely everything, and that is true of the metaverse. But I think over time, we'll start to see more and more color on those plans. Now, the last thing that's, I think, really worth noting, and it's worth saying that I think this last point really looms over the other two, which is that, Meta's governance, share structure, societal role is really under scrutiny. There are a lot of existential questions that are still haunting Meta. For instance, a lot of concerns about governance. For the first time in a while, I've been hearing about the dual class share structure, which of course is the case at a lot of tech companies, is the case at Meta, and gives CEO Mark Zuckerberg more voting power than the average shareholder. So there are concerns about that. Concerns about his hold on the company is what we were hearing from shareholders. There were also a lot of concerns about, frankly, Meta's societal role, the role that safety plays in Meta's practices and business. And the reality is, one of the things that kept coming up over and over again was concerns about the safety of children. And I think it's important to say this is something Meta has been fined for in terms of data privacy and children's data privacy by the EU. We actually only need to look back to a specific children's privacy fine in September 2022. When Meta was fined $400 million for concerns about children's safety. So bottom line here, what I would say is that the concerns that have dogged Meta are still very much there. They're just not showing up in the share price right now.
Wow. Thank you, Ali. Always a great report from you. Ali Garfinkel, our thanks to you.
The AI boom sparking a massive rally in tech. Nvidia has been one of the clear winners this year. Shares surging more than 160% since the start of the year, up 25% in just the last 5 days. Well, earlier this week, Nvidia reached a major milestone, briefly joining the $1 trillion valuation club. We'll hear with more on how to play the AI hype. We want to bring in Adam Johnson, portfolio manager of the Bullseye American Ingenuity Fund. Adam, it's great to see you here. So before we get into those specific plays, as a portfolio manager, how are you looking at this hype in AI? Is it warranted?
Did you say the hype in AI? Because I think it's actually the reality of AI. And if you listen to what management said earlier this week, it's actually a 10-year cycle. And I'm even going to go so far as to call it a super cycle. Let me put it to you this way, Shauna. Every computer that's out there, including this guy right here, the iPhone, it's basically too slow. It's not powerful enough, because I think what's going to happen is that artificial intelligence is going to become so synonymous with the way we operate, the way we think about the world around us, that what we're going to find is that we need more powerful chips. We're going to need new computers. That creates a replacement cycle that isn't just about the hype today and where's the stock going over the next week or two, but it's actually about sustained demand. It's why the company guided up and said, we're going to have $11 billion of revenue this quarter. And to put that in perspective, back in 2020, they had $11 billion in revenues for the whole year. So in just 2 years, they've effectively quadrupled the amount of money that's coming in the door. And I think that's just the beginning. So no, I don't think it's hype. I think it's actually the beginning of a super cycle.
So Adam, Diane here, who else are the winners here? Obviously, Nvidia has this clear lead. They joined the $1 trillion club this week. Who else are the clear winners in this AI, especially the generative AI space?
Yeah, well, Diane, there are not many. And that's in part why these names are running as hard as they are. I call it scarcity value. Obviously, you've got Nvidia. And the reason Nvidia is the play is that their chips are so fast, so much more powerful than the competition. The Nvidia chip is capable of 30 trillion calculations per second. That's like a million 1,000,000s 30 times. It's kind of hard to fathom, right? No other chip maker can come even close. That's why Nvidia is the proxy for artificial intelligence. But to your question, some of the software providers, there's C3.ai, which was founded by Tom Siebel. You may remember Siebel Systems back in the 90s. That's a company that actually helps companies design artificial intelligence gathering and predictive systems that will look at an entire network. You're Delta Airlines and you want to try to figure out how to optimize passengers, flights, crew, everything else. You put it into an AI-based program and it starts to look at the world differently and a lot more capably than we can at 30 trillion calculations per second. So C3.ai is one. Another that's been getting a lot of attention, although it's kind of funny because it's been so hated, is Palantir. By the way, the ticker on the first one is AI. Palantir is PLTR. Palantir was founded by Peter Thiel, maybe the most hated man in Silicon Valley, public enemy #1. He's very conservative, so he doesn't jibe with the whole ethos out in Silicon Valley. The government is Palantir's biggest customer at about 55% of revenues. And the other thing that Palantir does, which isn't great from my perspective as an analyst and a stock picker, is that while they're very good at pitching themselves to companies and winning the business, they go in with their team of AI scientists. They work for 9 months and then they leave. So they work so hard to get the customer, they make money for 9 months, and then they leave, and they don't really get that much in terms of subscriptions on the back end. So those are the reasons why Palantir hasn't hasn't gotten the vote from Wall Street that some of these other companies have. That said, Palantir was at $7 for months and months. It's now up to 14 or 15 in like a week. So yeah, there's a gold rush for these handful of names. There are not many of them.
Adam, what about the larger tech names? Obviously, Microsoft and Google, really the focal point when it comes to Bard, really Microsoft when it comes to ChatGPT. How much investment, I guess, interest do you have in those two names, given the fact that they are obviously far from those more pure plays that you were just talking about?
Well, I'm long them all because they're wonderful companies. But to your question, Shauna, no, they're not pure plays. They're not anywhere close. I mean, yes, Google is developing some in-house artificial intelligence. I mean, of course, they'd be crazy not to. Just as Microsoft has backed OpenAI, the company that created ChatGPT. But remember, I mean, even ChatGPT, which everybody's talking about, isn't making any kind of money to speak of at all. I mean, they gave the thing away for free last November, and now they're talking about business models where, you know, you can pay $20 a month or something. You know, that doesn't accomplish a whole lot. When you're talking about a company with tens of billions in revenue, the notion that Microsoft is an AI company is I think it's wishful. But no, I'm long Google for search. I'm long Microsoft because it has effectively become the backbone of the cloud, computing in the cloud. And yes, each of them has an AI practice. Each of them has an evolving AI approach. Frankly, so does Amazon, as you might expect, which is how they figure out how to sell us stuff. But if you want pure AI, I'm telling you, it's really hard to do. You got ticker AI, which is CA3. You've got Palantir, the most, run by the most hated man in Silicon Valley, and you got Nvidia, which makes chips, which powers AI, but it isn't AI per se. Again, it's a really small universe, and that's why all these companies are up so much. You know, everyone's jamming into these names and pushing them up.
All right, and I wonder if some of that's a little bit of that is FOMO. And so you mentioned C3 AI, OpenAI, C3 AI in particular. That stock taking a hit today amid some questions about its accounting, but it has AI in its name. What do you think that we can expect to see with regard to companies trying to get in the space or pivot, even how they brand themselves? We saw that before with Facebook becoming with Meta. Do you expect to see some of that in this space? And is that even a good idea?
Yeah, we've kind of seen this movie before, and it's funny how it seems to repeat about every 10 years. I mean, you mentioned Facebook that decided it was going to pivot to Meta and the metaverse. That didn't work out quite as planned, though I am long it. I bought it in the hole, and so far so good. Square, I've actually been buying, and that rebranded as Block in order to capitalize on the blockchain. But admittedly, that stock is down 60, 70%. If you remember back in the 2000s, everyone wanted to be a .com, and if you had, pets.com, that was the poster child. So that's why I say, we've sort of seen this movie before where something comes along and everyone says, oh yeah, we should do that. I mean, look at the SPAC boom, right? 2 to 3 years ago, everyone said, oh wow, if we really want to hit it big, we should create a SPAC. So there is that element to artificial intelligence, except that you actually have to come up with goods. You can't just create a website and say, we're going to sell XYZ and we're going to call ourselves XYZ.com. You actually have to have the computing power. You have to have the software. And I think that sets a much higher bar for this artificial intelligence build out. And the other thing, this is going to take many years. So there are going to be some winners and losers. You're not going to be able to see very many companies IPO yet because that window hasn't opened. It's been very tough on Wall Street. You report on layoffs. I mean, Goldman is laying off more as of today, right? So the IPO window hasn't opened. When it does, maybe next September, you're, I think, going to see 3-4 names that'll get a lot of attention, and they're all going to build themselves as the way to play AI. So stay tuned on that. In the meantime, just go buy Nvidia.
Nvidia, that's what everyone seems to be doing, at least over the last several months. Adam Johnson, great to have you. Thanks.
All right. JP Morgan Chase's longtime CEO, Jamie Dimon, hinting that he may be eyeing public office in a new interview, and he's already getting support for a White House run from hedge fund billionaire Bill Ackman, who tweeted about that today. Rick Newman joins us now with some fresh insight. Rick?
Well, Bill Ackman's point of view is that Jamie Dimon is well liked and well respected in the financial industry. So wouldn't he make a great presidential candidate? That is the Wall Street view of American politics, and it is not correct. I think Jamie Dimon, despite the fact that he's well known, clearly a successful business person, I think he would be a long shot if he were actually to announce a run. Remember, you have to run inside a political party to have a real shot. Presumably, he would run as a Democrat. And here's the problem. He's a banker. Democrats don't love bankers. And many Americans, more broadly speaking, don't love bankers either. So think about what happened when Mike Bloomberg thought he was going to run for the Democratic nomination. He completely flamed out in 2020. 2020 was also the year that Howard Schultz, who was the former CEO of Starbucks, indicated that he was interested. I think he pulled out for health reasons, but he generated basically no enthusiasm. So this idea that if you are a successful business person, a moderate who can speak to swing voters, even on social issues, that you're going to be a shoo-in for this job, not remotely true.
Rick, real quick, we got to go. But what about Treasury Secretary? Do you think that's something that maybe he would consider?
Oh, I think he has held that door open for a long time. It would most likely be in a Democratic presidency administration. But apparently, Janet Yellen is keeping that job. There were some rumors that she might step out after 2 years. She didn't. So he would need a Democrat to win and offer him the job.
Yeah. Just details, but you never know. You can never count out Jamie Dimon. We'll see what comes from him here over the next several years. Rick Newman, great to have you. Thanks. Well, coming up, we are counting down to the closing bell on Wall Street. Once again, losses across the board. The Dow off nearly 150. We'll be right back. Final 15 seconds of trading. You're looking at losses across the board, at least for today. The Dow off 124 points, S&P off just about 0.6%, as well as the Nasdaq. This also marks the final trading day for the month of May, where we have certainly seen tech be the leader in that space. The Nasdaq on track to close the month of May up just about 6%. And that marks the end of the trading day. Again, all three of the major averages closing in the red. The Dow closing off just around 122 points. When you take a look at the sector performance for today, we're looking at a bit of a mixed picture here as investors do try to figure out exactly what's going to happen with that debt deal down in D.C. But energy, by far the laggard in today's trading action, off just about 1.5%. And then industrials, materials, and financials also leading to the downside. Let's take a look at some of the individual movers of the day. And first up, Advance Auto Parts. That stock plunging 35%. The company cut its full year guidance, also slashed its dividend. It now sees full year 2023 EPS forecast in a range of $6 to $6.50. That's down from its prior forecast of $10.20 to $11.20, about a 40% cut that we're looking at to its outlook here, Diane. And when you take into account what we're hearing from the CEO, Tom Greco, he did warn that some of the competitive dynamics that Advance Auto Parts experienced in the first quarter, he expects that to continue at least for now.
Right. And what's interesting, though, in terms of what's happening to the stock, you had a little bit of a contagion effect to some of the competitors, like AutoZone, which also got dinged as well, but nothing like what we're seeing with Advance Auto Parts, which that looks to be like its worst day ever for that stock. Have to do a historical check just to confirm that. But again, you're seeing a little bit of a knock-on effect, but Oppenheimer put out a note saying that they think that the issues for Advance Auto Parts are kind of contained to that company and maybe, just isolated issues, operational issues there. Compared to its peers. On the flip side, though, you have shares of SoFi surging today, up about 15% as it reaps the reward of the debt deal. As it stands, the debt deal, which we know will be voted on tonight, includes language that would trigger student loan repayments. Why is that beneficial to SoFi? The payments had been paused for some time now. SoFi had sued the government earlier this year to end the repayment pause. We know that SoFi is a key player in the student loan sector, so hence being a beneficiary, reaping the rewards of the debt deal.
Yeah, the stock closing up the last two trading sessions up over 28%. The best two-day rally that we've seen since last August really just speaks to the role that SoFi does play in student loan payments. Piper Sandler out with a note today saying that they do expect demand for federal student loan refinances, obviously, to ramp up here in the third quarter. SoFi produced $1.7 to $2.1 billion worth of loans per quarter prior to the start of the moratorium. So a massive player within this space. Have had that the repayments will come back into play by the end of the summer. Clearly, SoFi will see a boost from that. Let's also take a look at shares of Hewlett-Packard Enterprise. The stock is falling today after the company missed revenue expectations, also reduced its annual sales guidance for the rest of the year. You're looking at losses of just about 7%. In HP there also off just about 6%. The computing giant did report weaker than expected results. That PC demand weighing on the company's earnings here. Personal system sales down 29% for the quarter. Both of the CEOs of HPE and HPQ speaking with Brian Sazi earlier today. They're both playing up the role that they are going to play within AI and how that could potentially boost their business here down the line.
It didn't help the stock, though, obviously.
Well, not yet. No, but but that's what they're saying, though. They're saying that it's going to be more of a longer-term play, and we're not going to see that until at least 12 to 24 months.
Right, I know, and because we've been talking about this AI, and every tech sector company obviously has to go big or go home on AI. But it's interesting to see the effect on both of these companies' sister stocks experiencing sister problems today.
Yeah, certainly both out of favor for investors, but Hewlett-Packard, HP there, one obviously really hurt by the slump that we've seen in PC sales, much of that mostly expected here with these results. All right, let's take a look at crypto. Bitcoin sliding over 7% in May, headed for its first negative month in just about a year here. David Hollerith David Hollerith is here with a closer look at the declines that we're seeing in that space. David.
Hey, Shauna. After 4 months in the green, Bitcoin is closing down about 7%. It's hit a peak in mid-April around $31,000, and since then it's kind of fluctuated in this range between $30,000 and $26,000. More recently, since that peak, it's lost about $66 billion in its market cap value. And so this total rise year to date has actually still been 63% so that's since the beginning of the year, and that has far outpaced the S&P and Nasdaq, but has fallen short of those major stock indexes with a 15% loss from a year ago today. So excluding this past day, which we've seen, the volatility for Bitcoin and other cryptocurrencies has dropped significantly in the past 30 days. And that signals a lack of selling or buying conviction amongst investors. Obviously, the hot labor data and Fed official talk has not been kind to Bitcoin either. Edward Moya, who was with Awanda, was telling us that Wall Street is appearing not to take as much interest into crypto as it has in past years. I say crypto, he said Bitcoin specifically. And it's important to point out, that this time last year, Bitcoin was at the beginning of what was a very long sell-off. That was pretty rough, and we saw a lot of company failures and potentially some fraud. So, even though it's a down month and things seem to be quiet, that might be interpreted as a better thing. Bitcoin and cryptocurrencies in general are still sort of trying to get past the hype from 2021 and are kind of looking for more application or utility for adoption. So that's the month of May. In June, it's about a toss-up historically in terms of what prices have done. We've seen gains in the month of June for about 5 of the 10 past years. And July is usually better. It's the 3rd best month historically for Bitcoin and crypto assets more broadly. I also do want to point out the stablecoin Tether has been on a tear since around the time of regional bank turmoil, which started in March. Tether has gained about $11 billion in market cap value. Its second competitor, Circle's USD coin, has lost about $14 billion for the same period. Diane?
All right, David, thank you so much. Coming up, we're joined by the CEO of Intuit to talk about the company's most recent quarter and more. Stick around. Intuit, the parent company of brands like TurboTax and Credit Karma, sheds light on financial needs for consumers and small businesses. From economic uncertainty to potential cuts in funds for the IRS, there's quite a bit at play for the financial tech platform. Here to discuss this and more is Intuit CEO Suzanne Godarzi, along with our Yahoo Finance's Brian Sozzi. So Suzanne, let's start with this. Let's start with the debt ceiling deal that's going to be voted on today. What does that signal for your business?
Well, first of all, thank you for having me. Great to see the both of you. Well, we're just happy for the country because we don't want the country to go into default. In terms of impact to our business, I think it doesn't have any impact other than it's important for the United States not to go into default, and we think that's a really good thing. And we're happy that there's a deal being cut and we can move on as a nation.
Suzanne, Brian here. Good to see you as always. I think, I read like 8 notes before we reported earnings I believe last week, on how this free e-file system that the government may stand up may impact your business. But I mean, come on, can the government get a website right?
It's good to see you, Brian. Our perspective has been consistent in the last 10 plus years. First and foremost, free software already exists for all Americans, and this will yet be another, free tax software. We don't think it's a great use of taxpayer money, given the existence of free tax software, and so it's really not an event for us as a business. It's not material at all for us. And I'll just remind us that in the last several years, there's been 2 huge entrants into the space. One, before we acquired Credit Karma, which has well over 120 million members, they chose to get into the tax business, and they really had very little impact, and they were all free. And then the company that we sold the Credit Karma tax to, once we acquired Credit Karma, also provides free tax software, and it's not had a huge impact. So the point is, free software already exists. For the government to create yet another free software does not make an impact to our business.
So I got to ask you, one of the big buzzwords that we've talked about a lot lately and, in recent months is AI. Some companies are all in on AI. Just about every company talks about how they're incorporating it in their business, including companies that you wouldn't even think of, like a Pepsi. So where do you all stand? Are you all in, or there is also the camp that is kind of warning about the dangers of AI? Where do you all stand as a company on AI and how you'll be using it in your business?
Yeah, first of all, I've been on the record, it's almost been 5 years ago, that I believe, and we believe as a company, that next to electricity and the internet, AI is the biggest platform that will ignite innovation across every single industry. And particularly with generative AI, we believe that it will create new companies. Existing companies can get disrupted. And depending on how you choose to leverage it, it's an enormous opportunity. And I think the opportunity first starts with data. And when I think about Intuit and what we are focused on for our customers, we have a 360 view of our customers. And I'll just use a small business as an example. Small business of 10 people, they have to do a lot of work to figure out how to manage their customers, how to get new customers, how to sell more services to the customers that they have, knowing which ones are profitable customers, which products are profitable, and then being able to manage their cash flow. And the power of AI is with all of the data that we have. We see all the money coming in, all the money going out, and all the transactional data. We have customer data and purchasing data. We're actually able to automate what a small business needs to do today by helping put marketing campaigns together for them that they can edit, confirm, and have it run, and have it help them understand how did that campaign produce results? Where is there an opportunity to produce better results? To be able to understand how to manage their cash flow, to get access to capital when needed. And with data and with AI, you really have the opportunity to be the platform that fuels the success of small businesses. And the same thing holds true for consumers. So we are huge believers of AI, particularly knowledge engineering, machine learning, and now generative AI. And I don't think it's hype. Now, there are dangers with any technology that you have to be thoughtful about. You have to have governance around. You have to have standards around. But this is the real deal. And I think that it will deliver benefits in ways for customers that we could never imagine possible. And it's very exciting from our perspective.
So, Son, out of your two marquee businesses, let's stay with MailChimp and TurboTax. Where will AI play the biggest role, and how do you monetize that?
Yeah, well, I'll start with MailChimp. With MailChimp, one of the things we recently launched is email content generator that's all fueled by data, machine learning, and generative AI. What that means is we, in essence, will generate the content for a customer to be able to market to their customers. I'll stick with email for a moment. We'll propose to them a title that we know works very, very well from behavioral and longitudinal data that we have across millions of small businesses. Plus, based on what services they want to sell, we'll pull together what the actual campaign will look like. And all they have to do is edit it, review it. It's all done for them proactively. And to ensure that they're comfortable with it, they hit send. And not only do we now auto-generate it, but we can come back to the customer and help them understand how many people viewed it, how many people actually made a purchase, those that didn't make a purchase, who are they, what services do they have, to give them segment reporting that then they can generate, and we can generate for them automatically the next sort of generation of marketing. So that's a very specific example for MailChimp. Let me go to TurboTax, and then I'll answer your question about monetization. One of the elements of our investments that started 5 years ago in context of AI was what we call knowledge engineering. And knowledge engineering, in essence, turns rules and the relationship between all the data that we have and the specific data that we have for the customer into code and into recommendations. And so a lot of the way we produce our code across the TurboTax platform, the questions we choose to ask customers, the areas where we choose not to engage the customer. And then when we bring an expert to engage the customer, it can be a bot, it can be a human being. And all of that is driven by AI. And in fact, 2 years ago, we had a generative AI launch where when an expert is engaging a customer, the entire conversation, the call summary, everything is captured. And the expert doesn't have to do that work. It's captured in the system. They can also cut and paste what they need and follow up with the customer. That is all based on knowledge engineering, machine learning, and now generative AI capabilities. And it really drives automation. And the biggest opportunity for us is to disrupt the assisted segment. It's labor intensive. It's a lot of manual work, a lot of documentation capture. With our investments in AI, it's going to help us accelerate the disruption of those that need help to do it digitally anywhere that they wish. To your question around monetization, and I'll end with this, we often talk about the fact that we have a $300 billion total addressable market, and our penetration is 5%. And although our company has been growing double digits, it's what excites us about the next 10 years. Now, why is penetration so hard? You're dealing with people's money, right? You're trying to help a small business grow their customers, manage their cash flow. You're trying to help a consumer, save money, get out of debt, get their taxes done. And when it comes to money, people are fearful of, are they doing it right? Are they confident in their decisions? And for us, all of our AI investments over the last 5+ years, and now our acceleration with generative AI, actually helps us make things more personalized, more humanized, more engaging. That therefore allows us to penetrate at an accelerated rate, which results in growth for the company. So we see it as a disruption to accelerate penetration and to disrupt the mid-market and the up-market that we're focused on serving. We don't see it as we'll monetize generative AI only and some customers don't get it. We see it as a fuel for our entire platform.
All right, well, we will have to leave it there for today. Intuit CEO Sazan Ghadarzi and Yahoo Finance's own Brian Sozzi. Our thanks to both of you. Meantime, coming up, we go around the horn and check in on some of the top trending stories of the day. Stay with us. All right, time now to take a look at some of the top trending stories of the day with Yahoo Finance's Alexandra Canal and Josh Schaefer joining us for our little roundtable today. Up first, ahead of Jobs Day, we're seeing this. More high school grads are getting into blue-collar jobs rather than going to college. This is based on some recent government data showing the recent college enrollment date for high school grads. This is ages 16 to 24 had dropped last year to 62% from just over 66% in 2019. That was pre-pandemic. So we're just seeing this trend of people going to the job market and seeing what they can get out there first, Allie.
Yeah, and a few things stood out to me. One being the fact that more women than men are entering college. Like you said, a big part of that that's driving it is trade schools, those blue collar jobs. But this is interesting because I've actually had this conversation with several friends, family. I'm always going to be a proponent of more education. However, if you are someone that doesn't know what they want to do, you're not going to take advantage of that degree. You're not going to take advantage of the programs that college offers. Then you're going to leave college heavily in debt, still not knowing what you want to do. So in a way, I do think it's good that these high school students are thinking about the meaning of college, what they want to get out of college, because these are young kids, 17 years old. It's really hard to know exactly what you want to do. So I'm not totally surprised by the results of this study, because I do think a lot of people are second guessing the value of a college degree.
I think that's it, right? Is the value proposition has just fully changed. When you think about how much in the last decade college tuition has, how much that has gone up, and then also just the last 3 years of what the pandemic was. I mean, as someone that finished college in 2020 and experienced part of pandemic college, very different experience, and probably wouldn't have paid the same amount of money for that. And I know a lot of people felt that way even 2021, 2022. Maybe I'll just work rather than go into college, when they fully hadn't figured out the remote work. To pay as much as people pay for college and then learn remotely, I think kind of changed the way people think about college.
Yeah, and I think we're getting at the heart of the issue here, because I think so much of it comes down to the cost of college, especially these private institutions will charge, over $70,000 a year. Clearly, if you do go to college, you get a top job, a very good job. The earnings potential from going to college outweighs not going to college, just in terms of what that trajectory looks like. There's been a number of studies on this, but if you are in the group who maybe it's not going to pay off, maybe you don't know exactly what you want to do, either take a break, go and get some experience. A lot of these apprenticeships have really taken off here in terms of internships as well. Maybe narrow it down before you go back to school. I'm a big proponent of the higher education.
So
I do think it does pay off, but you got to ask yourself, if you're pursuing one of those careers that it doesn't make the most sense, then hey, it does make a heck of a lot of sense to maybe take a break or just go right into some of those jobs.
And we often talk about inflation here. Education inflation is much higher than the general level of inflation that we talk about. So that is certainly, like you mentioned, Josh, the cost proposition. Also, did you really just say 2020?
2020?
No, oh my gosh, Josh is a wonder kid.
But the one thing I think that was interesting too when I was looking at some of this stuff was just the unemployment rate that you see from people ages 16 to 24. It's lowest level since the 1950s. That's not something I would normally look at. So just this made me get on that train. I thought that was pretty fascinating. And then you look at the JOLTS report from today and just jobs are available.
Right.
I think that's the biggest thing. We'd be talking about something different if these kids were looking for jobs and the job market was a little tighter. Right now, you can find that job.
Yeah, and I wonder what this means for if you want to get your law degree or your MBA. We have seen studies that people are still going on to get their MBA, but that's a big question.
Yeah, and even some of the most competitive MBA programs have been having a tough time attracting the typical number of applicants that they are used to seeing. All right, guys, let's also talk about another big story that I like today. The price of broadcasting for women's sports might be going up pretty soon. Now, this might not be a huge surprise given the fact that many of these women's games have been attracting more and more viewers. But Josh, when you take into account what exactly is going up for media rights renewal, you got a couple of really attractive leagues that are going to be up here. WNBA is one of them. NCAA March Madness, the women's tournament, is also in the mix. How much they could potentially get for these leagues is crazy, considering some of the deals that have been reached over the last decade. Just take into account, I think it tells it all, is the championship game this year between LSU and Iowa. 10 million people watch that. So these higher prices, it's clearly warranted.
10 million people watch that, and less than 3 million people watch the finale of Succession. Maybe that tells you where people should be putting their money, right? But I think that's, if you're ESPN, you want to be the one-stop shop for sports, and specifically basketball. If they renew those NBA rights, you want the WNBA, you want college basketball, because then you get a basketball fan and you can offer them that full thing, right? I think ESPN, when you think, it's a different conversation when you're talking about ESPN versus some of the other sports streamers as far as what ESPN needs to provide. And I think having that women's coverage is something they've built out. They honestly, Allie, they just have a bigger content library than I think a lot of the other streamers that you cover.
Yeah, and they're not just doing the live sports, right? There's a Serena Williams documentary. They're getting into sports betting and fantasy. So they have this full coverage. I love this quote from Jimmy Pitaro, who's a chairman at ESPN. He said, "We know that the more we invest, the more we grow the leagues, the harder it's going to be for us to renew. From my perspective, that's a high-class problem." So I do think it's this win-win, and especially when you talk about advertising, we have this ongoing writer strike right now.
Yep.
What do advertisers want? They want that live content. They want that live sports. It's an easy sell.
It is. And at sports, to your point earlier about the viewership usually draws in more viewers. You know, you compare it to different shows and different award shows, and they're the leaders typically sports. So no surprise that they're investing more in that. And ESPN saying they know they're going to have to pay more. They realize, and you also have fantasy leagues, women's fantasy leagues coming into play here, driving demand here. And also, of course, the story of Brittany Griner. I think that drummed up a lot of interest in the WNBA. You know, her situation with coming back from Russia, President Biden being involved with that. Clearly, that had an impact on interest.
And ESPN's just been a great strategic partner when it comes to women's sports. There's a lot of studies out there about women's fans being more engaged, right? As Allie was saying, advertising, you can make more money off a women's sports fan, according to multiple different studies that we've covered, versus a men's sports fan. They're more engaged. It's more of an opt-in experience. And I think that that's something that ESPN is also taking great advantage of when you think about what they've been able to do with the WNBA, with college basketball.
And with so many sports, even with women's lacrosse. I mean, I'm a little biased here, but what they have broadcasted for those games when it comes to college lacrosse, just getting that more of a national scale, getting that exposure out there to so many people who probably didn't know about lacrosse before, especially if you're a younger girl that's looking to play that sport. I mean, what they have done is incredible, and it's going to be amazing to see, I think, how much some of these rights end up going for over the next couple of years.
Partnering with the right people always matters, right? Yes. And Adidas maybe didn't do that, right? They partnered with Kanye West, and now they have a lot of Yeezy sneakers, but they're back on the market. So Adidas says that a significant amount of the proceeds from these Yeezy sales that went on sale today are going to be donated to selected organizations working to combat discrimination and hate, including racism and anti-Semitism. So this, of course, comes after Kanye West's multiple different comments that then led to him losing his partnership with Adidas. Adidas has been holding on to these sneakers that have a revenue value of over $1 billion for several months now. They're bringing them back to market. I think it's very interesting. There's a launch page for these sneakers. There was a countdown clock for when they're going to put the sneakers out. It rubbed me the wrong way a little bit, Diane. At some point, it's either lean into you're going to be donating these glorified donating these sneakers, and they're going to the money's going to go to the right cause, or stop promoting them.
Right.
Because I don't really love the way that they're promoting them if that's sort of the image that they're going for.
Because originally they signaled before that they were just kind of washing their hands of the whole situation. And the idea that they signaled before was that they were just going to go away. I mean, like you just, and to see them kind of doing an about face, especially with how much fallout there was from this, it just doesn't seem like the right move. And again, they haven't indicated how much of the proceeds will go towards fighting racism, et cetera.
Hate, right.
Yeah, hate.
Because you're talking about, again, over $1 billion worth of shoes out there.
Right, but
I mean, these were anti-Semitic remarks.
But we've seen companies do this all the time, right? I mean, I think back to Travis Scott and the Astroworld tragedy. He had brand deals with Nike, with Dior. They all said they were reevaluating, but they just ended up pushing those launches till the news cycle calmed down a bit, and then, here we go. So this doesn't fully surprise me. I think if there's a demand out there, they're going to lean into that, which is a bit of a pessimistic view. But
this was a little surprising to me. I was actually hoping that they were going to donate the rest of the shoes that they did have. I won't be surprised if there is more and more backlash from the fact that they are going in on this. They're trying to capitalize. They should be donating at least 100% of the proceeds.
Like that was what they
not.
Sorry,
but maybe they'll be able to change that.
It's the greed of corporate. I don't know.
Corporate greed.
The one other thing that'll be fascinating to watch will be the second secondary market, because that was what Adidas said. Was
And that's going to be
the shoes
huge.
are going to get sold anyway,
Yeah.
so we should sell them.
Yeah, and we're going for about $1,000 in some sites.
Right.
All right, guys, we got to leave it there. But coming up, we are joined by Illinois Congresswoman Jan Schakowsky. She joins us to discuss her take on the debt limit legislation that's being negotiated right now or voted on right now. Stay tuned.
The House will vote later this evening on the debt deal, which suspends the debt ceiling for 2 years. The Congressional Budget Office estimates the bill will cut federal spending by $1.5 trillion over a decade. Now, the legislation claws back some funding for the IRS and ends President Biden's student loan repayment freeze. The bill needs 218 yay votes to pass. Joining us now is Illinois Congresswoman Jan Schakowsky, Chief Deputy Whip for the Democrats. Congresswoman Schakowsky, let's get right into where this stands. Is it going to get across the finish line? Are there enough votes?
Well, not without Democratic votes. We saw right now that the 29 Republicans didn't even vote for the rule. They were able to get most of the votes that they needed to bring it to a final vote, but they can't do it without Democrats supporting it. There's a lot of their members that are just not buying this.
Congresswoman Nishana here, do you support the deal?
So here's how I feel. I'm not going to vote to allow a default. So if it got that close, I would certainly vote in favor of making sure that we, don't put the whole country into a tailspin. On the other hand, I'm going to vote no because I think the fact that they brought us to the brink of total disaster of the American economy by holding everybody hostage. No, I'm going to vote no because of that. I'm not happy about the rules having to do with the SNAP program, the food assistance program. I'm not happy with the cuts to the IRS. I am not happy with the pipeline that they want to do. So I have a number of things that I'm not happy about that deserve, I think, a no vote. But my first priority is to make sure that at the end of the day, these Republicans don't take us into total default, which would be a complete disaster.
So if you vote no, Congresswoman Schakowsky, and others follow suit, other Democrats follow suit, there is that risk that you talk about with regard to the debt ceiling. Go ahead.
Well, I'm going to watch the votes as they come in, and I'm going to wait until I see that there will be passage. And it's true that my no would be more of a symbolic vote. But I'm sorry, I am not going to go without at least expressing my punishment for what they have done so far to bring us to this point. But I'm going to assure that I am not going to be a deciding vote that would, ruin our economy.
Congresswoman, then do you not agree with the way that President Biden went about this? Because I think on the one hand, people are saying, hey, this is a sign of a reasonable compromise, given the fact that you have progressives on one side and the far right on the other side who are both unhappy with this deal. So those in the middle are showing the signs that, hey, maybe that this is a sign of a relatively stable compromise.
We are going to have to vote in September on a budget agreement, that's where you do that kind of negotiating. But what you see that President Biden was able to do was to protect Social Security and Medicare and Medicaid, which they really wanted to do to help finance money for veterans and for homeless people. We kept all of the benefits of the bills that we passed last year, the Inflation Reduction Act, which puts a lot of money into climate. So I'm very proud of what the president did. He saved the infrastructure bill that we need so bad, the CHIPS and science bill. So there were a lot of good things that they would have liked to have destroyed, that they weren't able to do that on the Republican side.
Congresswoman Schakowsky, what gives you cause for concern? You mentioned the SNAP program. I know the work requirements piece has been a big sticking point. What is it that stands out to you that's troubling?
Who is going to, at 50 years old, now it's up to 54, who's going to go out and try and get a job? And I want to tell you, who are those people by and large? I think what we're looking at is older women. Are there jobs out there for a 52-year-old woman or woman of color to go out and get a job in order to get $6 a day? That's what the SNAP program gives you so that you can put a little bit of food on the table. This is the richest country in the world at the richest point in history. And the fact that there is prevalent hunger in the United States of America to begin with is absolutely shameless. And now to say that it's not enough to be age 50, we have to raise that and make it even harder. Especially, I believe, it's going to be for women and probably women of color.
All right, Congresswoman Jan Schakowsky, we appreciate you so much for joining us. We certainly will be watching that vote later today.
Thank you so much. Anytime, I'd be with you. Thank you.
All right.
Everyone is watching Nvidia as we close out the month of May. The stock briefly joining the $1 trillion club on Wall Street during yesterday's session. Shares of Nvidia, though, closing the trading day off just about 5.5%. Now, to achieve that $1 trillion level, the stock would have to close above $404.86 a share. Now, the big question for investors now, is it too late to get in on the stock? Here with some of the stock buying and selling tips, content creator Ross Mack, Macconomics financial expert. Ross, it's great to have you back again. So I think a lot of people are out there wondering if they missed the boat on Nvidia. What do you think?
Well, one, thank you so much for having me. And the question of, did you miss the boat? That's obviously a loaded question. What I would say is, short answer is no. Would I rush to get in right now? Short answer, again, is no. And the reason I say that is here, right? If you look and ask yourself, what is your time horizon? If you were to look and say, is Nvidia going to be higher 5 years from now? The answer is probably yes. If you were to say, should I get in right now? I think you could get in maybe cheaper moving forward, right? I think if you look at certain things, certain indicators right now when it comes to if you should buy a stock, you got to look and say the vast majority of people that are buying Nvidia currently, they have to understand that the stock right now is very overextended, right? I think when I ask myself, am I going to buy a stock? I love to look at it and try to get it at a discount, right? And so Nvidia right now, it's a lot of hype. It is arguably, not arguably, one of the best performing stocks year to date. And that's because of, they are the forefront when it comes to artificial intelligence. However, I think there could very well be a cheaper price that you can get in. And I think when you're determining that, I think two great indicators to look at is the RSI, which is the relative strength indicator. And that is just literally letting you know from a momentum standpoint, is it overheated? And, that number is going to go from 0 to 100. And anytime it's over 70, that means, yes, it is overextended, meaning it's overbought. And now's the time that people are probably going to start taking some profits. And, so when I take a step back and I say, when is a good time to buy? One, the true and greatest approach, right, that has been proven is dollar cost average, right? And so if you were to be a person and say, hey, I have $1,000 to start investing in Nvidia today, what I would say is, one, it's very difficult for the average person to try to time the market, let alone professionals, right? So it's a very hard concept to grasp. So what I would rather you do is just dollar cost average. Maybe you're putting $100 every other week or every month or so, up until you actually get to your $1,000 being fully invested. And why that's good is because, one, is going to allow you to take the guessing game out of it, right? Because the vast majority of people, when they're investing, they get a little nervous. Should I buy now or should I wait? And a lot of times you find yourself, taking too long and actually missing out on a trade. But I've got a lot of people in my community who are asking, is now a good time to actually buy the stock? And I told them I think it's going to come down some, because a lot of sophisticated investors and institutional investors are going to start taking profits because, one, they're looking at it being it's overextended.
So Ross, Diane here. I want to ask you, you posed the idea of if you have 1,000, where you would put it. Let's say just getting that extra $1,000. So a lot more people have side hustles. There's a recent Bankrate survey out showing about nearly 40% of Americans have a side hustle. So what do you say? What do you tell people about where to go to get those extra funds? And then what do you do with that?
I love that, right? I think we could all agree that we are in, some alarming times when inflation is so high and the cost of living is constantly increasing, yet rates or wages are not increasing at that rate. And so some people literally, in order to make ends meet, they need a side hustle. And so when it comes to actually having a good side hustle, one, I think you need to first understand the actual way you want to structure your business, right? And most times you're probably going to want to get an LLC, and that's a very cost-efficient way of being able to now remove your own personal liability from your own side hustle, your business. But the reason I say that is, one, understanding that the tax code in the U.S. was made for business owners to tax employees. So once you become a business owner and say you still have a W-2 job, well, what you get to understand, and obviously here's the caveat, speak with your own tax professional, but one thing you're going to understand is that by having that LLC, you're going to see a lot of business expenses are going to be a deductible, right? Just the cost of doing business, which in turn will keep you from spending more money when it comes to taxes, right? So I think understanding what business structure you want to have, chances is going to be an LLC. Another thing I want you to understand is work on branding, right? You want to post content. You want to post content daily or every other day or once a week, but be consistent so that your brand is something that people are going to know is synonymous with being a great product or a great service. And another thing, and lastly, understand what your competitive advantage is. See what your competitors are doing, and from there, figure out, are you able to do that better or are you able to do that cheaper? But figure out what that is and understand that people need to be coming to you for either a better service or a great service that's just slightly cheaper.
So Ross, if you have the side hustle, you're getting more income than you were prior to that. So how should people go about trying to figure out their budget and how much they should be saving versus spending on a month-to-month basis?
I love that, right? One thing, at the end of the day, right, we're seeing alarming statistics that over 60% of Americans are living paycheck to paycheck, right? And at the end of the day, the number one goal, how you want to think about your budget, spend less than what you make. And so when I start thinking about that, the very first thing I want to do is saying, how can I start automating my savings? How can I start automating paying my bills? And everything starts with the budget. So in order for you to actually track your inflows and outflows, and once you're doing that, that's going to give you a good understanding of, okay, am I living beyond my means or am I living above or below my means? And what steps do I need to do in order to now get below and back at a comfortable rate. And so at the end of the day, I like for a person to not spend more than 50% of their monthly income on their necessities. And that is being your rent, your food, your insurance, groceries, et cetera, right? And from there, I want you to say, okay, the things that I want to do, whether it's traveling, dining out, I don't want you to be spending more than 30% of your after-tax take-home pay on that. And then lastly, 20% should be for saving, investing, and paying down debt, right? I think we know that now we're approaching $1 trillion in credit card debt, people. The average interest rate we're paying is roughly 20%. And so once you start thinking about the best ways to save, spend less than what you are making, and then more importantly, try to avoid spending so much on credit card debt. And clearly, it's a problem here in America.
It is. I mean, it's the consumerism that is so part of just kind of the American culture. But Ross, we are going to have to put a pin in our conversation. We always appreciate having you on, Ross Mack, and we love your videos on Instagram. Thank you.
It's an honor. Thank you guys so much for having me.
All right. Coming up, we'll check in on a few trending tickers moving after hours. Stick around. The debt limit deal looks to make its way through Congress after President Biden and House Speaker Kevin McCarthy reached an agreement on the debt ceiling and government spending. We had U.S. Secretary of Transportation Pete Buttigieg on Yahoo Finance earlier today to discuss this and more. Let's take a listen.
The unilateral House Republican bill would have meant really savage cuts to a lot of very important things that we do, from rail safety to air traffic control. We're still assessing the best ways to accommodate the caps and the restraints that are part of this deal. Not everything that we would want to see, but that's what you're going to get in divided government when there's a negotiation. I don't think either side got everything that they wanted, but at the end of the day, this is a deal that is workable, that is consistent with our department's ability to meet its mission, and most importantly, that will prevent a default that would just be absolutely unacceptable and economically catastrophic, which I think is what everybody's rightly focused on, making sure that America can put behind us so we can get on to work after that X date with a deal in hand.
Mr. Secretary, just staying on the debt ceiling deal, does that impact any cuts there? Does that impact efforts that you've undertaken to improve rail safety and to improve travel by airlines in this country?
we're certainly going to be able to continue our work. And I would add that there's more to come on this, not just what's happening in terms of the budget, but active legislative processes on both. When it comes to railway safety, there is the Bipartisan Railway Safety Act, which was advanced through committee. Would like to see that pass the Senate and the House and get to the president's desk, because it gives us more tools to work with to hold these railroad companies accountable. I think before the Norfolk Southern derailment, many Americans hadn't seen just how often incidents happen around the country. This is going to be a major step forward in preventing more of those. On the aviation safety side and the customer service side, we are full steam ahead. We are advancing a rule that would create compensation for passengers when an airlines are responsible for a major delay or cancellation. We're working on rules around fees and refundability, transparency. All of that work is going to continue in the context of this bipartisan deal.
Mr. Secretary, you mentioned Norfolk Southern and the railroads. Now, I talked to Norfolk Southern CEO about a week and a half ago and try to get a sense on where he is at after the derailment. Now, he told me they are not going to stop fully implementing precision railroading, which a lot of experts suggest are leading to derailments for Norfolk Southern and a lot of others in the railroad industry. What would be your response to that? Is that something that must end?
Oh, I expect every railroad company to go, not just to meet the letter of the law, but to go the extra mile when it comes to safety, and we're pushing them to do that. I continue to be concerned about this push for cost cutting. A lot of these measures go by the collective name of precision scheduled railroading, although I've never seen a completely satisfactory definition of all the things that go into that. Bottom line is there needs to be a level of safety and accountability. I'll give you an example that we're continuing to pursue, which is a requirement that there be at least 2 people on board a train. To me, this is basic common sense, but believe it or not, railroads have continued to push to be able to have just 1 person, even on a train that could be 2, 3, or more miles long. I also want to mention, by the way, that we're doing work that doesn't just depend on what railroad companies do or don't do to improve infrastructure in ways that is going to mean fewer railroad crossings, locations where there's more of a hazard of a crash, and just as importantly, even if there's no incident or collision, you have long trains or stopped trains getting in the way of people and sometimes emergency vehicles going about their days. One of the great things about the infrastructure law is it provides us funding to act on that, and we're working with communities, and we'll be making announcements soon about that railroad crossing elimination. So we're making sure that it is safer and more convenient. We're pushing the railroad companies to do the right thing. And let me mention one other thing that I was pleased to see Norfolk Southern announce, and several of the Class 1 railroads have taken steps toward, which is reaching agreements with their unions to deliver sick leave. You remember this was a big sticking point and a very tough issue last year as we faced a possible strike. The strike was prevented, but the president and the administration continue to say we believe that all railroad workers ought to have sick leave. With these deals, these now bring us into the reality of a majority of union railroad workers in America having access to that sick leave. And of course, we'd like to see that majority become 100%.
A big thanks to U.S. Secretary of Transportation Pete Buttigieg, as well as the Yahoo Finance Morning team. Let's get it right over to Shauna Smith for some after-hours movers. Shauna?
All right, thanks there, Diane. We're looking at 4 names up on the board for you: Nordstrom, Salesforce, CrowdStrike, and C3 AI. Kicking off with the gainer here in extended trading, and that is Nordstrom. We're looking at gains of just about 9% here from the retailer. A strong report beating on both the top and bottom lines, even though they did report a year-over-year decline in some of these major categories here. Sales were off 11% compared to a year ago. Nordstrom Rack did beat, but it was a decline from a year-over-year basis. Digital sales was also off 17% on a year-over-year basis, but it did come in better than what the street was bracing itself for. Year to date, we're looking at losses of just about 5% over the last year. Nordstrom off 42%. We've talked time and time again about this retailer struggling to regain its momentum, struggling with this turnaround strategy to move the retailer forward. We'll see whether or not the gains in extended trading stick. Moving on here to Salesforce, another mover in extended trading. That stock off just over 3% right now. The earnings were decent, but the revenue growth outlook, that disappointed the street. This focus here on profit, that's a little cause of concern just in terms of what that would mean for future revenue growth. Year to date, we're looking at gains of nearly 70% when it comes to Salesforce's most recent performance. Q1 did beat on sales and earnings, but we are seeing the stock drop because of that sales outlook. Again, off just about 3%. CrowdStrike, another mover here, off just around 11.5%. Full year profit forecast on the low end of expectations. That's the big driver in after hours action. The company did raise its full year revenue forecast. They also did beat during the first quarter revenue, $692 million, but the guidance, once again, the driver here. And C3 AI, a stock that is up 257% year to date. We're looking at losses just about 13% in extended trading here. Taking a look at these numbers, the AI boom clearly really riding that wave here to the upside since the start of the year. When it comes to revenue, that did beat. They also posted a narrower than expected loss. But again, when you're looking at a return of 257% since the start of the year, you could give back some of those gains, and that's why we're seeing the stock off just about 13%, Diane.
Yeah, definitely there is some room for give back there. All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.